Welcome everybody for joining this webinar, CW research on macro outlook in a new brave world, given the virus pandemic that has confronted the world and the economic sort of well-being of our current world outlook, as well as the present state. I'm Robert Madeira. I'm the Managing Director and Head of Research. I'll walk you through a couple of pages today to give you a little bit of a viewpoint and perspective of where we've arrived, where we are, and potentially where we will be going from here. This is obviously sort of a big, broad topic, a lot of moving parts. A lot of it is still unknown where we will end up, but we will try and shed a little bit of light by sharing some highlights from perspectives that may be interesting to reflect a little bit on, incorporate a little bit into our thinking, and prepare ourselves for addressing, both as an industry and as well as professionals, confronting the very strategic and operational decisions that we will need to learn to live with in a new way and adapt to emerge both alive as well as stronger, hopefully, in the best case. So we'll take you through a couple of pages just to give a quick introduction to who we are for CW Group and myself. For those that don't know, I'm as I was saying, the Managing Director and Head of Research, and I lead in particular the economic and macroeconomic research and our advisory projects for our clients. CW, we're organized into three different areas: advisory, research, and our market reporting. And advisory provides both strategic and M&A, as well as economic and operational consulting services and transaction services to industrial segments around the world. The research team prepares our benchmark forecasts, industry reports, specific thematic reports on various different topics, such as price assessments and other sort of data sets that are required to make precise decisions in today's economic reality. We cover various industrial segments. Most of them are heavy industrials, and we sort of work across those around the world. Now, getting into a little bit of the coronavirus, a lot of you have already, of course, read much about sort of where we are and all the headline figures. But to kind of get a little bit of a reset, we're today looking at a fairly substantial global spread of the virus. There's no region that really has been spared. Numbers are scarce and estimates at best. But there's no question about it that we're looking at mortality rates. If we look at Johns Hopkins information that's been shared, they are quite elevated based on information that they had available, looking around 7%. And this is kind of why we are in the world that we are today. With a concern, obviously, for the well-being and of citizens around the world. Some areas have been affected more heavily than others for a variety of reasons, both public health, how the response is being sort of designed. But this is, of course, stating the obvious, something that the world has not seen for a very long time. This is kind of the 100-year storm, potentially. Maybe it's the 500-year storm. In the sense that this is something that we expect to see, for sort of a couple of centuries. Last time there was something that was of this magnitude was the Spanish flu back in the sort of beginning of the 20th century, which swept the world, which was, of course, a very different place, very different scientific understanding, very different public health sort of situation and capabilities that could be brought to bear. But since then, we haven't really seen anything like this in the world, and that's why there's an uncertainty as to sort of where we will be going with this. The response has been obvious, as everybody on this webinar today realizes. Social distancing obviously has been sort of front and center, become the topic sort of the year for how to both interact, for how to live, how to coexist, and how to sort of operate as economic entities around the world. And this has been, something that's been quite different in terms of how it's been rolled out across the world. Some countries are being more prescriptive, some are being a little bit more laissez-faire. But if we just look at the US and kind of all the different social activities that have ceased. You know, the recreational events have of course pretty much stopped. There's really nothing for maybe some of the outdoor venues, like sort of theme parks that have tried to remain open, but everything else is pretty much canceled and postponed, reflecting the requirement to stay socially distanced and people staying away from each other to avoid further contagion. And this is obviously impacting real life. People are not going out for dinners. And just take UK as an example. I mean, it's come to a standstill. If you look at these numbers, year-on-year changes, it's at minus 100%, which is not surprising, obviously, since you're kind of not allowed to go out for dinners anymore. And even in some of the pictures here show, even in China, Wuhan, the origin of this virus, we kind of have a little bit of return to normalcy when some of these sort of more socially engaged activities are returning, such as going out to restaurants. But you can kind of see the division of spacing between different people and how you know, that has led to kind of a changed behavior and how we sort of need to operate differently. And this is obviously something that's being discussed in sort of the Western world as well, and even sort of in New York region where I am. The restaurants are talking about how do we return to kind of service with the social business model. Do we keep sort of every other table, and do people even go to restaurants? That's a big question. Do we have a permanent change here where, yes, maybe restaurants open up, but we won't really see you know, a return in that sense to the normal. And obviously, if people are not able to leave their houses, we can't really go and buy things like the way we used to. We don't need to buy things the way we used to. And one of the areas impacted is car sales, automotive sales, which account for a substantial part of the GDPs in most nations. And in the UK, they just came out with figures today saying that the UK car sales are the lowest since 1946. So this is right after World War II. That's the level of car sales we're seeing this month. There was about 4,600 cars sold, and most of those 4,600 cars were sold, and this is for the entire nation of the UK, were sold as part of fleet sales with ongoing contracts. So it's essentially stuff that companies couldn't really get out of. And this is not really reflective of people going and buying new cars. Similarly, in the skies, we also have a standstill. Air travel obviously has been hammered, and there's no traveling to speak of that's happening sort of in airplanes. And as on this page, the airports have become parking lots for jets. And as we kind of will mention a little bit later on, the layoffs that are starting to happen in the airline sector, or have happened, are staggering, with 90%, 95%, for instance, of Norwegian staff has been furloughed to start with. United Airlines came out today saying that they're firing 300 people to sort of right size. And of course, this is sort of rippling across the world, and the airline sector is not going to survive as a whole without additional support from sort of government funding and special loan programs to kind of make it happen. So that's what are the long-term implications here for both cargo traffic, spare parts, not a just-in-time inventory, because a lot of that inventory, of course, is transported airplanes and passenger airplanes. So some of those are, of course, being converted to cargo-only airplanes, but that's a small part of the overall transportation. And then obviously the travel industry is looking at staggering losses as there's really no travel happening, whether it be air, be it land, or hotels, or sort of entertainment that sort of goes along with that. So the ripple effects just keep propagating across. And the numbers we're talking about is sort of 500 billion losses estimated for the travel sector in the US this year alone, and this is just the US as an example. And when we have all those stoppages, then the question is what happens to our manufacturing base? Well, one of the indications that we can sort of look at is electricity consumption. And we haven't in the US had electricity that's this low in the last 16 years, since the last sort of major sort of recession. And that's, of course, an indication of industrial sort of decline and demand decline, indicating sort of that slowdown. And the silver lining here, although this is an indication also of stoppages, is that global carbon dioxide emissions are in decades. So already we're projecting, and we're all seeing already in first quarter, we're sort of 5% lower in carbon emissions than last year, and that's great sort of on the surface. But obviously the driver of this is a lack of manufacturing, which of course includes many of the industrial segments of sort of our clients and many of you on this webinar, reflecting the reduced need for, be it cement or other products that will require fairly carbon intensive manufacturing. And of course, there's a correlation between this and the power generation, especially in coal generated electrical countries. And transportation, looking across the world, port traffic has sort of collapsed as there's less manufacturing. If there's no manufacturing, there's less cargo ports. We were already a little bit of trouble in global trade before this all started with the US and China, trade situation that was still playing out. And now with the lower demand, this is kind of, declining even further. We're seeing some declines to like, 30% of cargo traffic and 13% of sort of rail compared to sort of normal conditions, just to give a couple of examples. And if you look at the demand destruction that implies, it's just staggering, because if there's no logistics transportation, and remember what it is that it transports, and it's products for industrial and retail consumers. So this then reflects ultimately a lack of demand. And considering that food supply chains are still up, even though they're sort of creaking a little bit and there's some fracturing on the margins, this decline is mostly coming from the industrial base. So that means that we're pretty much having a stoppage across the global industrial base, both inland, domestic, as well as international, sort of comparing the hinterland and the port traffic. And sort of draw your attention to chart in the bottom left, looking at sort of UK transport patterns, sort of just even in the last month, which is not a very long period, but how much it's declined in this very short period. Forget about even looking at previous years and how this compares. But essentially, it's the only type of traffic that we have are sort of random cars driving on the roads and so trucks. But rail is down. Of course, public transport is almost non-existent at this point. And then what this all means, and we sort of pick up the US here as an example, but the story is the same everywhere. Maybe it's like a little harsher in the US because it doesn't have sort of the social limitations that Europe sort of has in place. So there's easier to right-size the workforce to sort of fit with demand and can react faster. But in the US, at least we look at sort of, the weekly unemployment claims, we haven't seen anything ever of this magnitude for those weekly claims. Back in the 80s, it was kind of a couple 100,000. Now we're talking millions of people at each week that are adding to the unemployment claim, which will obviously drive the unemployment totals in the end. And the year already sort of jumped up to about 20 million, which is just a staggering increase from having, not many months ago, US having had the best unemployment figure in an extremely long time. And this number is going to continue increasing. There's stuff that we kind of see in the news every day that will continue driving this unemployment forward, because we're just starting to see decisions playing out, cash reserves evaporating, and companies having to sort of trim further and further. And obviously, if there's demand destruction, what are we manufacturing for? And that's kind of a fairly sobering view on the rest of this year and as we go forward, because if there's no consumer demand, then obviously we cannot have an economic recovery, really, since it's still representing the vast majority, or at least the majority of economic activity in most Western countries. The stock markets have obviously become extremely volatile as a result. Nobody really knows where we're headed. It's very hard to crystal ball at this point and determine, if we're going to go left or right, or where we may end up happening. And if we look at sort of the stock market volatility, take the VIX index as a reference point marker there. It's kind of in the last month, 2 months, it's just spiked, as we really don't know how the stimulus are going to play out. It's come down a little bit as we have got more clarity on, in the US, more stimulus coming out to support industry, small businesses, and also unemployment in various states and local government. But with this volatility, it's kind of a question of whether we're going to continue improving. It's a dead cat bounce. We had a little bit of recovery, but once company earnings are starting to play out, which will take sort of quarters to really truly measure the impact, we're going to probably see, if not more volatility, definitely more downwards pressure in these markets. And to that point, if we pick up kind of 4 sectors that we are active in and where we operate, so look at softwood lumber, sort of paper and pulp, look at for building materials and crude oil for sort of pet coke and energy sector, and of course infrastructure and sort of shipping rates. The story is the same everywhere. There's no sector that's escaping in this world. Softwood prices are down dramatically year on year. Housing starts are sort of falling off a cliff, and this is a very short time period. This is only just comparing the last 3 months. If we compare to 2018, this decline in housing starts is sort of staggering in the US. We're sort of come to complete standstill for new builds there. Silver lining a little bit is for stimulus 4, wave 4, phase 4 in the US, we're talking about including a potential infrastructure program that might support construction activity, at least on sort of the public spending side. But that's still going to take maybe a little bit of while, and before we sort of get any true visibility on whether that's going to happen or not. Oil prices obviously have collapsed completely. We're below production cost for most oil producing countries, and we're definitely below budgeted oil prices for virtually all producing nations. At the current prices, we essentially have no incentive as oil producers or sort of are more upstream to pump oil, and even to the point where demand has evaporated. And of course, in the last couple of weeks, we've seen negative pricing for oil for the first time ever, which is just a mind-boggling state of affairs. And this is due to there just not being any demand, and it's not that easy to switch off an oil well. So in sort of West Texas, intermediate crude, we saw sort of that decline into negative territory with essentially all storage full, and there's no room to take any more storage, and therefore the pricing sort of being negative for people just to take the crude away from producers to sort of place somewhere. And obviously, if there are no goods shipped around the world, then the shipping demand, supply and demand, is very simple economics. Shipping rates, again, which never really recovered in the last sort of 10 years from their peaks, but they have evaporated fairly dramatically as global trade and bulk trade has slowed down commensurately with the industry, and as we've talked about on the port pages. One of the things that's kind of happening here is deflation at work. We're looking at the world where almost every company in the US, not every company, but many companies have started enacting salary cuts. It is happening to most people that I know across industries, service industries, manufacturing, and the US has the benefit of being a flexible economy in the sense that it's possible to adjust salaries as needed for companies to be able to maintain the staffing. So instead of staffing, or maybe in addition to staffing, but to cut costs, there has been across the board announcements, and it's not likely to stop happening anytime soon, or just be sort of returned to normal. These are probably fairly permanent. There's a lot of unemployed people, and so when there's a lot of supply of people, and there's little demand, obviously pricing sort of acts accordingly. And although many of these are being cast as temporary, it's doubtful that they will sort of be recovered in a time in the short period. So we have another sort of big force, and this is not just kind of a top level thing. This is 20% salary cut across the board, 10% or whatever it is across various industries. So we'll have a big deflationary headwind, especially with oil coming down. And if you look at the deflationary basket, and the deflationary basket is kind of the list of goods and services that we track, or the economists track to determine what inflation is. Two of the major components are sort of falling, and there's just no way to see how this inflation can, in the short, medium term, take hold. And this is even, made worse by the economic outlook, or maybe this is as we have economic activity deteriorating across pretty much every country in the world. There's very little juice to kind of keep propelling the economy and driving higher demand for services, products that would support higher prices or pricing power. So we're entering a world of price competition. This quarter is going to be, a bloodbath in terms of GDP figures. US, if we just look at a couple of banks and what they're seeing, we're talking, Deutsche is probably a little bit more optimistic, but the other banks, we're talking sort of 35 to 40% decline in GDP. That is a staggering number. That's a number we have never seen before anywhere, not any peacetime, not even during war times have we seen numbers like this. Even though there is a kind of consensus that Q2 and Q3 will improve and we will recover some by having fairly strong growth in those quarters. That's to some extent also built a little bit on wishful thinking, but we are seeing some movement towards reopening economies in the US. We're seeing a move towards trying to get economic activity up and going. Obviously, that's going to be a big tension, and it's a big discussion between public health and economic sort of policy and desire to revive the economy. That's playing out in particular in election year. Being that the economy has been hammered, and supporting a little bit of the outlook for improved figures is, of course, the massive fiscal stimulus that have been approved in the US and already being rolled out also in Europe and in other places to support the economic drop-off through grants, loans, stimulus, purchasing, whatever mechanisms this takes. But this, as central bank U.S. central banker, said the other day, this is not a time to think about deficits. This is a time to just roll out sort of Keynesian economics and all the tools that you have to get the economy to keep moving. Think about the deficit at a different point. We gotta live to fight another day, in essence. That's kind of the mantra right now. The budget deficits have exploded in the last quarter. All the projections that were in place before have just been blown out of the water. We've added about $4 trillion of extra debt to the U.S. economy. The U.S. has the ability to be acting a bit more aggressive, but even Europe has added. Europe has, of course, the problem of being countries and EU central bank, which always complicates things. So it has also not been able to act as swiftly or aggressively, but each country has taken measures, as well as the European Central Bank, sort of with an $800 billion program to get things rolling. And of course, other countries are also doing the best they can to get things moving forward. And will we ever see an end to this? I don't know, but it's hard to see at the moment a true end to this, a complete resolution without the vaccine being in place. If we get a vaccine in place, and if there's a miracle discovery in the short term, if that happens in the next couple of months, miraculously, then we could have a rapid return in the economy. Of course, there's going to be sort of battered and bruised and a lot of band-aids, and we will take some time to dig our way back, but the structural damage will be more limited. If this is something that starts dragging on, we will just have to figure out how to live with this in the normal and keep working on a vaccine. But until then, things can sort of come and go. And in my mind, there's no doubt that we'll have a second wave of infections as soon as things open up. We will go back into another wave of increases in all the sort of mortality rates and infection rates, just like the Spanish flu. I don't think there's any real way around it. We just have to sort of figure out how to live with it at that point. And these, at the end, the economic damages is something that we've never seen. Anyone has ever seen. But the little more positive news is that governments have acted fairly quickly, driven by the U.S. in particular, Europe as well, to sort of move things ahead. With all these deficits, if we do come with a conclusion or resolution in the form of vaccine sooner rather than later, then it is not without any concern we would look at the deficits that have been added. This is a massive inflationary pressure that's kind of sitting there as a ticking time bomb, which at the moment is not really relevant because, again, we gotta live to fight another day. But if we recover quickly, or when we recover eventually, that is going to be something that has a material impact on currency rates, FX rates, through the inflationary sort of mechanisms that we see. The good sort of news is that, of course, good, but interest rates are low, zero or negative even in some respects. So there's room to, of course, increase rates, but that's obviously not good also for the economy and growth. So that's something of a huge can that's been kicked down the road. And at some point there will be a moment of reckoning. But in 3 years, 5 years, 10 years, unclear at this point. We're still trying to figure out sort of what's going to happen in the summer. So some of the demand that we're losing now that will never be made up, services in particular. Will there be some pent-up demand? There was discussion initially, so January, when it was really only a Chinese problem, and the question was like whether demand was going to pick up again afterwards and get reabsorb all the products that being essentially not purchased in that initial period. And there was talk about if this went on for 1 month, 2 months, demand would still be there, and we would sort of run out and buy new cars and everything because everybody's essentially being itching to buy stuff that hadn't happened, or build a new house or make improvements. But a little hard to see that at the moment, and I think the damage then is going to take longer to, of course, then recover. And the question is, like, what happens if we don't get a vaccine? This is the new normal. This is the world we live in, and at some point, people will be tired of being at home, and they already are. We can see in Spain, we can see problems in the US. People are demonstrating, they're taking sort of action to not be locked down and sort of sequestered. And there's economic activity. Is the cure worse than the disease if we're keeping everybody at home? So at some point, and we're reaching that point where impatiently economists are looking to sort of open up at the expense potentially of sort of public health. And there's also then the question is, do we sacrifice our sort of children's future and their welfare for the old and sick in our economies? And this is a fairly sort of complex question, but in essence, if you put the mortality profiles of most countries, and there's more and more statistics that are coming out, and more data. Yesterday, they released data for New York City, which is kind of the epicenter, become the epicenter of the outbreak now, and 95%, 96% of people that died all had pre-existing conditions, be it obesity, be it diabetes, and quote unquote normal people and young people have been largely spared. So the question is here a little bit about what's fair and how we trade off the costs in sort of our economies and the prospects of our the younger generations versus the older generations. And I think this is going to be a big question for the particular sort of the Western world as we sort of go forward, and there's maybe not a solution or vaccine anytime soon. And then sort of on the last sort of positive note, is that this is something that's been talked about for decades. That is the potential for a pandemic. It's not something that really like nobody thought of. This is not something that just came out of the blue. It's just a question. It was always a question of when. And this kind of relating to my last point about the trade-offs between the young and the old, this is a fairly benign virus. And even though the mortality rates are, we were talking about sort of 7% on a global base, that mortality rate is vastly inflated because the only really way to track this today is with insufficient, incomplete data, and you really only track sort of what's in the hospital. But the ones that end up in the hospital or tested are the ones that have problems to start with. So if you look at what mortality rate is number of people that died divided by number of people tested, infected. We haven't really done much testing as a world. So that number, obviously, if you're not testing many people, that percentage is going to be looking much higher. If you look at estimates that are kind of indicating a little bit better based on statistics in New York, and this was released 2 weeks ago, they're seeing mortality rates which are closer to maybe 1%, maybe even 0.6%, depending a bit on how you look at the statistics. And 0.6% is a lot better than 7%. And then you start approaching the 0.1, 0.2 of the typical flu. I think we need to sort of look at that a little bit more. And once we get numbers, maybe there's also, that's one of the drivers to be able to accept the new normal as sort of we see it. Now, the big scary part is that there could be other things lurking out there. Obviously, we've seen regional issues before, like Ebola flaring up across Africa multiple times. But if there was of this virus nature that was actually much more mortal and much more dangerous and permanently dangerous, then we'd be in a real world of pain compared to what we're now. And what are companies going to do structurally? What are people going to change in terms of behaviors? Are people going to go back to their old ways after this? That's all open for discussion. It's a very uncertain future at the moment, and the structural changes are, I believe, permanent. And the only way to prepare for it is to think about how to enact new structures, make new sort of models, because the world has to go on, even with this new world order. So on that positive note, hopefully this shed some light on this issue, the situation we find ourselves in, give some thought and provide some perspectives for reflection, to be able to not just sort of ride along, but to make some proactive decisions how to prepare businesses, prepare and make decisions to confront the new world and emerge on the other side of this in as good potential as possible. So on that note, thank you very much, everybody, for participating today. And if there are any questions, feel free to reach out to us, your account manager, or our general email, and we'll be happy to engage with you in further discussions. Thank you.